Welcome to the May edition of the series. So far we have covered the two different categories of edge in the markets, and then we've also talked about the edge development process. Today we're going to talk a little bit about data mining, which is a way to get ideas and potentially improve ideas, but I want to give the caveats and also my personal experiences with data mining. So the edges we have in this series, the different strategies we've created, the first four have largely been based on some sort of price action phenomenon. What we're introducing today in this month's series, as well as the next few months moving forward, is going to be seasonality. So what is seasonality? Well, it's some sort of phenomenon that exists in the world just because of how the world is structured. And it might be also related to entire sectors, entire types of assets. Commodities are a great example of markets where there's just seasonal patterns of bullishness and bearishness depending on the time of the year. But there's also seasonality that exists based on things like day of the week. Um, is it election year, post-election year? Who is president? Or rather, do we have a Democratic president? Do we have a Republican president? There's just all sorts of seasonality. There's also intraday seasonality. Uh, I mean, it exists everywhere. And what's incredible about this is that all of these effects, not necessarily all of them, but like a good number of these effects, if you choose ones um, that are capturing different phenomena, you can actually create a portfolio that has low correlation, at least strategy wise, just purely based on seasonality. And the other thing about this is that because these are phenomena that exist because of the way the world is structured or how things happen in the world, it's unlikely that these are going to go away. They sit a little bit more on the risk premium side than the inefficiency side. So here are some examples of seasonality from the Build Alpha blog. Build Alpha is a data mining software that I'll talk about in a couple slides. Here are two simple strategies to just capture low-hanging fruit seasonal effects just based on day of the week. Most algo traders that have been around for some time probably already have heard of these or know of them, just because when you first move into trading from investing, if you never did discretionary trading and you just went straight to algo trading, you probably have heard that seasonal strategies are what you should start with, either that or something like a moving average crossover. But the ones that are seasonal are the ones that are pretty popular because again they lay more on the risk premium side, so they're more likely to persist rather than just get ironed out over time. So if you're a member of our Patreon, meaning you're a member of the community, um, I am slowly uploading my data on seasonality into the community. So I'm creating sections. Right now it's primarily U.S. equities, but I'll be adding a commodities section to show all my commodities data, and then probably also a currencies section as well. And then for in addition to those sections that explain the different sort of seasonal phenomena and have the data to back up each of those, I also provide strategies with entire source code for how you might take advantage of all that seasonality. So again, if you're someone who just wants to come in and just get a bunch of strategies, I think the Patreon honestly provides pretty good value for its price. And then we also have some tools if you want to investigate and analyze market data, try to find new seasonal phenomena yourself. I have recently released a Google Sheet for day of week seasonality analysis, but there will be more tools that I release over time to kind of assist you guys with more efficient ways to dig up seasonal effects. So I previously talked about Build Alpha and Strategy Quant. These are tools that market themselves as bringing the power of advanced quant firms to you as a retail trader. And they also advertise themselves as a way to build great strategies without knowing or needing to know how to code. And to me, I think that's great marketing, but I would not use them that way. And that is because most of the rules that they come up with are going to be arbitrary and probably don't make sense. You're not going to be able to explain a lot of their rules to most people if you just have them running overnight for weeks, just trying to find indicator combinations that happen to produce profitable strategies. And that's just because what they'll be able to do is find some sort of mathematical phenomenon that produces a great backtest, but is unlikely to work moving live. And the best way to show this is you have these tools data mine from like 2000 to 2023, and then take the rules that it comes up with, and then just blind test out in 2024. You see that those rules would not have held up, or maybe the strategy goes sideways or sideways to down. And so, again, it kind of goes back to that edge development process. You need to have a theory as to why you have an edge, and then you need to vet it. And then if it's something that makes sense and is explainable, then it's more likely to work moving forward. But there is a step in there called incubation, and I'll talk a little bit about that near the end of this video too, when we reintroduce data mining to see if it can come up with an additional entry criteria to improve an existing strategy. So the best way to use data mining, in my opinion, is to try to identify areas where you should probably be looking for edge. So if you're intraday, using it to find, for example, is there a day of the week and maybe even an hour or set of hours within that day of the week where the market is most likely trending for a particular instrument, like let's say the NASDAQ. And that would be a great way to identify, well, if I'm a trend trader, then this is probably when I should be trading. This is the time period I should be studying rather than like the entire day, and trying to form a strategy for that time period. And of course, seasonality exists in all sorts of forms, like what holiday is coming up next, what day of the week is it, what season is it? Is it a post-election year, pre-election year? Do we have a Democratic Congress, Democratic president? Just all sorts of seasonality exists that tends to have varying degrees of correlation with each other. So let's go ahead and take the turnaround Tuesday strategy. The version that I data mined is actually a little bit different than this. So this one says you just buy Tuesday's open if Monday was a bear bar, and then you sell Wednesday's open. Historically, Wednesday has been the biggest gain of the week. And so I found that you would actually have better gains if you just bought Monday's close and then sold Wednesday's close, at least historically. And so let's go ahead and create that for our initial strategy. The rules are simply today has to be Monday, close as a bear bar, and then we exit on Wednesday's close. This is the equity curve. If this was an intraday trading strategy, this actually wouldn't be too bad of an equity curve. A lot of the top day traders tend to have an equity curve and stats similar to this. But the problem is that for daily trade strategies, I like to have a profit factor of at least 1.75 and a win rate of at least 70%. So let's go ahead and see what happens if we add my favorite long entry criteria, which is that the bar has to close in the bottom 20% of its range. This is what that looks like. The only rule that we've added is that the closing price has to be in the bottom 20% of the day's range. And so you'll see that this filter, at least for the long side, is incredibly powerful. It adds a profit factor of nearly 1. So whereas the previous version returned about $1.60 for every dollar you risked, this one has a slightly higher win rate and returns almost $2.70 for every dollar that you risked. Unfortunately, the win rate is still not quite up to what I'm willing to consider for live trading. So one way to see if this can be improved is to use data mining. And I also want to do this because I want to kind of give you an example of how data mining can be used throughout the process and not just for finding ideas. And also to show the kind of criteria or indicators that data mining comes up with. So if we use data mining to try to improve the strategy to hit my criteria, you usually end up with something kind of it comes up with something that's difficult to explain. And it's even worse if you just try to use data mining to just produce the strategy from the outset. So the main thing is that what data mining comes up with should not immediately be discarded or approved. It often is something interesting. So here it's saying calculate a average of the high minus low. So that's basically a simple moving average. Usually the simple moving average is based on closing prices, but it's saying that it found a way to improve the strategy by doing a simple moving average of the high minus low. Now that is an interesting idea. I don't know if it necessarily has merit, but it certainly is a different take than what most people would think. And so this is where I think data mining is great for ideas because it gets you to think differently about the market. And then it's saying that any length for that SMA between 20 and 30 would meet my criteria. So I'm going to go ahead and show the equity curve of the full list of rules, but the length arguably makes sense. So 20 bars on the daily chart is about 1 month, and 30 bars on the daily chart is about 1.5 months. So maybe there's some monthly level uh, somewhere that is relevant, and this is a way to capture it. I mean, I don't know. It's that's something I'm inferring from the length, but I don't know for sure. And that's just another downside of data mining is you just don't know. You don't know exactly how to explain um, from why this rule makes sense. And so the rule that it adds is that today has to close below yesterday's close, so that's most likely going to be Friday. But if Friday was a holiday, then it'd be Thursday. But it's not just yesterday's close; it's yesterday's close minus the simple moving average of the high minus low. And then I chose the past 25 bars because it's in between 20 and 30. And then you multiply that simple moving average by 0.25. So in the parentheses there, I show the actual rules. It's close 1 minus 0.25 times SMA high minus low 25. And if that makes no sense to you, yeah, it doesn't make much sense to me either. So even though it produced a better backtest, we don't know for sure if we actually made a better strategy. And that's what happens when you data mine. You come up with interesting ideas that might just be a mathematical phenomenon that worked in the past, but you don't know for sure that it's going to work in the future. And that is why incubation is important, and it's a critical part of the edge development process. If you've ever wondered why can't I just take the strategy that has a great backtest and makes sense logically, why can't I just go live with it? Well, I mean, there's many reasons why. And some of the tools that we have in the Discord for recency are able to show why an effect might be getting front run, as we call it, which basically means if there was if the strategy performed well historically, but now it seems like people are catching on, and instead of the historical exit condition being the best way to trade it, maybe you have to shift that exit condition slightly forward or change it slightly just to capture what has been more effective in recent years. We have tools for that in the Discord, um, and that's another reason to incubate is if you see that your strategy has produced a great backtest but has largely gone sideways in the incubation, that's often a sign that the strategy might just be getting front run. Maybe some of the exit conditions need to be changed around rather than the strategy doesn't work. But also might mean that strategy just doesn't work and it's been ironed out of the market. So it's better to incubate and kind of determine that rather than just testing live and learning the hard way that the strategy is either going sideways or down and not up. As people say, hope is not a trading strategy. So just, it still applies even with algo trading. You want to be able to see how it would perform on data that has not been tested before, basically the future. But what we're going to be doing in the next few strategies is talking a little bit more about seasonality. I'll be introducing different types of seasonality strategies, which will hopefully give you a way to think about seasonalities and where to find edges and ideas for edges a little bit more beyond just price action. And also just because these sort of seasonality strategies that are based on different ideas are likely to have low correlation to each other and also low correlation to the existing strategies in the series that we've produced. And so it's a great addition to any portfolio, regardless of whether you're a trader or even just someone who dabbles in trading and just wants to add a few trading strategies to your investment portfolio. But the The very next video after this, of course, is going to be the one where I show you how to code this strategy in Pine Script. So if you've been following the series up to this point, you might already know how to do that. So feel free to skip that video if you already know how to code it. Otherwise, please check that out. And again, by the end of the year, we're going to have a entire portfolio of back-tested strategies with low correlation to each other that are basically capturing different types of edges in the market. So hopefully you've been enjoying the series so far. If you like what you see, please hit the like or subscribe button. And then if you want to join our community to really talk about this stuff, then please consider joining the Patreon. Thank you for watching, and I will see you guys in the next video.